Okay, so thank you very much. Thank you. It's a real pleasure and it's an honor really to be here and deliver this Per Jacobson lecture in Basel at the BIS, where I've been participating to so many board and governors meetings for so many years. I'll speak only 30 minutes, so I will refer to my written text that will be ready to be read for those who want to read it tomorrow, but I think you can scan it here. Now, the outline is the one that you can see here. I'm pleased to give this lecture in the name of Per Jacobson, as Per Jacobson was really greatly admired at the Bank of Italy. He was a close friend of officers of the bank. He participated actively in the program, the stabilization program that after the Second World War was able to take inflation, bring inflation from 100% to zero in a matter of months. And with those officers, he shared the view that that was really due to excessive liquidity and financial dominance, to use Rago's word. But we're talking about 100%, not about 10%, but still, that was the time. One of those officers was Paolo Baffi. Paolo Baffi became governor a few years later, but at the time when Jacobson left the BIS to become managing director of the fund, Baffi actually took over from Jacobson for 4 years as an interim economic advisor, being both economic advisor to the Bank of Italy in Rome and here at the BIS. Baffi had to face the high inflation of the 1970s, an inflation which was lower than the 100% that we experienced post-war, after the war, but which was much more difficult to tame. It was not only due to the two oil shocks that were pretty severe, but also to conditions which were a little bit different than today. And most countries around the world face that kind of inflationary environment. Germany was the outlier. Ottmar Hissing says because of the stability culture that had been inherited after the war by the Germans, it has also to be said because of total absence in Germany by law of indexation, automatic indexation mechanism, and the strong Deutschmark that after the collapse of Bretton Woods, they were able to maintain through their own monetary policy. The similarities of the shocks are there, but I think that differences prevail because of an enormous changes taken place in the last in 30 to 40 years on the political side, technological, demographic, and so on, because of changes in markets, because of changes in institutions, the most important being the independence of central banks, and with two main differences, I think, with respect to the current situation, experience. One is initial conditions. They were pro-inflation at the time. Basically, there had been other shocks besides the oil shocks that really had engineered the inflation of the 70s. And what we have, a major difference, is that those shocks, however, were persistent, while these shocks, at the end, both the supply disruptions and the energy shocks have proved to be, after all, really temporary. Now, there have been several comprehensive accounts of the inflationary surge, of central bank responses, the progressive decline in inflation. I had a lot of reading to do this spring, but I would start with this quote. The quote is by the editors of an excellent e-book published by the CPR in February, and the editors, are Bill English, Christine Forbes, I think she must be there here somewhere, and Angel Ubide, and it is a real interesting text. But what is interesting is this conclusion, which says that, in short, the aggressive monetary policy response central banks ultimately put in place may have been enough to ensure that the inflation effects of the COVID-related disruptions were actually transitory. in the end. I mean, we use this word transitory too much, but this is the conclusion. I think that there should be some nuance there. I think I basically agree with the bottom line. I would add that not only the COVID-related disruptions, but also the energy shocks really were actually transitory in the end. And it is a good starting point. In my text, there is a long discussion about evidence, aggregate evidence. I will do it very quickly. But the main point which I would emphasize is that actually there have been similar inflation patterns, but different underlying sources. In the United States, I think the pent-up demand due to strict controls, the lockdowns, the social distancing and so on in the 2020, coupled with the extraordinarily expensive fiscal programs by both administrations, had at the end brought a big surge in aggregate demand. That was especially where there was less contact, that is in consumer durables, and it was extraordinary. Now, the two figures really can summarize this. 2020, GDP fell in the United States by 3%. Personal disposable income, same year, increased by 6% in real terms. Nothing like this happened in Europe. There were many observations that this would have led to high inflation because of the working of labor markets would have followed the inflation that would have increased through expectations and so on, catch up, and both Blanchard and Summers wrote pieces on this. The case in Europe was totally different. In Europe, what mattered was this, was an explosion in the price of natural gas, which is the most important component of energy. Nothing like this in the United States. The United States produced it. Europe imported it from Russia. Russia started to cut supply already in 2021. We noticed it, but we did not understand. And that really started pushing up prices at the end of the year. But it looked temporary. Most of the projections was for this going down. And then we had the Russian invasion of Ukraine in 2021 that really made the difference. At the end of 22, we started observing, however, a decline, a rather sharp decline in inflation, first in headline and then in core. In Europe, it took some time for core to adjust. It was the pass-through of energy costs through the production chain really that took time. In the United States, demand was working, and so there is much more synchronization between headline and core. The central banks were acting in a delayed fashion. I will say something about the criticism on that, but at the end they acted very aggressively and significantly. And you can see key rates where policy rates increased dramatically in 2022-23. The QT also started, and so we are observing this reduction in the balance sheets. There was a lot discussed this morning in the BIS presentation. There were many major errors. I skip that. We know this. Mostly 22 reasons are both not having taken into account the supply disruptions, and the second is having had the wrong assumptions on energy both in the central banks, but especially in the markets. And at the end, there was an underprediction, substantial underprediction of inflation. But monetary policy, acting aggressively, was able to increase real interest rates already by the beginning of 23, starting from very low levels, negative, and the whole curve became positive in the spring of 2023 in the euro area, same in the United States. Now, inflation expectations, short term followed, basically, adaptively followed the actual inflation behavior, but long-term expectations, it has been emphasized by Agustin this morning, were maintained, well anchored. And we read the tightness of monetary policy in the aggregates. There's been a lot of discussion. We do not look at aggregates. Well, you central bankers don't look at aggregates. But actually, you see two things from here. First, that aggregates matter, and they were substantially reduced in 23 to zero, basically, in terms of rates of change. But the second is that if you look carefully at the euro area, you see more or less, if you plotted here nominal GDP, you'd see it clearly, not much of an overhang. And this has been an issue that has been discussed at length in a number of quarters. Now, this is the evidence. There has been a lot of other evidence also at a granular level. I would start with my personal assessment, making 2 points. The first is that we have initial conditions. Initial conditions were years of low inflation. Some of us thought that the risks of deflation, that deflation were high. Actually, there was some de-anchoring visible in inflation expectations. And that was a long period, too long according to Rago, and I understand that, but the question is what alternative, and of quantitative easing, unconventional monetary policy. Now, the second thing, however, is crucial, is the pandemic was really an unprecedented global shock. What happened there, it was that we felt that the consequence might have been extraordinarily negative, and consequence also on the social point of view, not only on the economic, and they had to be addressed. How they were addressed? Well, at the time, some of you remember, but we were discussing a lot about scarring effects, about the new normality that would have been very difficult to ascertain given the radical uncertainty. That was the year in which Mervyn introduced the radical uncertainty word in place of Knightian uncertainty that some of us studied when we were younger. But the interesting here is that what happened out of this expansion of fiscal and monetary policy to make up with the risks, it happened exactly what we saw before. A sudden rebound in demand and a severe disruption in supply brought inflation up materially. There was an anticipated and considerably and considered manageable, if you want, when it was anticipated, effect of these disruptions and excess demand. There was fast propagation, especially in the United States, but one result is really significant, and the result is the one delivered by Bernanke and Blanchard last year in their estimates, that basically this was a story of product markets and not of labor markets. And even if we observed increases in wages in 2021 because of also, among other things, participation rates going down, so the vacancy ratios being much larger than employed. What you observe really in this period is that wages basically were silent, not responding to an anticipated inflation. It's a crucial result. It was tested also in Europe, and also in Europe it came out to be zero in Italy. That is a totally different world from what we had in the 1970s and 80s. And it was very small overall Europe, perhaps a little bit positive because I think of the response of Germany and the Netherlands. The rise of inflation could have been limited and temporary if the pass-through of higher cost to final prices had been sufficiently slow, but sectoral interdependencies were at play, and there were remarkable non-linearities. And this is the second result. The second result is that working through product prices, we observed, and there was good research that was pointing to this, we observed that the frequency of price adjustments after the shocks was much higher than it was experienced up to then. And this is a title of, I think, a paper that was written, been published last year or this year. Large shocks travel fast. They affect both producer and consumer prices. There are also papers on ECB, also Bank of Italy, that shows that energy shock goes to consumer prices much faster this time than it used to do, even perhaps in the 70s. But this is very important because this is a combination of events. Not much in the labor market, a lot in the product market with this increase. Now, there has been criticism, obviously, to all this, and the criticism had to do with the delay in the monetary response. Central banks waited before responding. Obviously, there was this issue about communication. It was communicated if these shocks are transitory, so somebody was saying we look through because they are supply shocks. I'm skeptical about the idea that central banks look through because I will say in a moment, but really the delay was there. The question is, even if delayed, has monetary policy been effective after all? Remember, in 2022, at the end of 2022, already inflation started to decline. And it was the time in which the shocks reversed. That is, there was a reversal of the major supply shock in Europe and the fading out of the disruption of global value chains. Now, the criticisms were, first, that central banks were still had somehow fighting deflation, and also during the pandemic, perhaps they should have not. The second was that I wrote, join the transitory team. Basically, I was saying this is transitory, don't worry. And the third is that they had the sequence so that they first tapered QE and then started increasing rates. Now, these are factually correct, but the interpretation, I think, could be discussed. It's no doubt that the initial conditions were very easy. Main discussion was, in fact, to avoid the risk of deflation associated with pandemic. And second thing, how to get out of the effective lower trap. We had a long discussion during our strategic review in the ECB about this, and the idea was we have negative interest rates, and inflation much below still core 2%, we have to do something that it's clearly pushing that direction. But I think really the jury is out on how important, and this is for historians, not for economists, how important these expansionary policies have been to move from the most acute phase of the pandemic to a much more normal situation. In the absence of that, the production of vaccines, the diffusion, the confidence of people would have returned so quickly or not. This is a question which I would keep there, but there is no question in my mind that still in 2021 we were worried about pandemic, at least in central banks. We did not meet in this house 2021. Jackson Hole was by remote. We were having discussion, governors on the screens, and we were worried about the second wave of the pandemics at the time. So this somehow may go to explain a little bit also the hesitancy. And perhaps it was too much, but certainly that was there. On the transitory team, well, I think as far as the ECB is concerned, yes, we said that looked transitory to us. We did not see much happening much effect of the bottlenecks in Europe, even if there was some. And we interpret supply cuts by Russia as due to the bad weather there and perhaps to political problems with Nord Stream 2 pipeline. The sequencing, yes, we adhere to that. It would have been very difficult to do otherwise. The big question raised by Ragu is you had QE too long before the pandemic, maybe, but it was the only game in town, monetary policy. And the alternatives were not there. We may discuss how to engineer a different kind of response. Effectiveness, yes, it was effective, I think. I think that still we were very much worried about second-round effects. At the end, we saw this happening, and we moved. And we risked to move from, as Agustin was saying, and Claudio, from a low inflation to a high inflation regime. And the high inflation at the end has been temporary. Because supply disruption and energy shocks were reversed. But was the sharp tightening of monetary policy helpful in this case, or we should have just had the reversal having its effects? And I think here one can have a very brief detour. Think of inflation as a combination of forces, costs, demand, supply imbalances, the behavior of producers and wage sectors, the expectations. A formal representation is a statistical model. Think of solving this statistical model with inflation in terms of its past. Say a linear autoregression. Impose homogeneity, because after all, nominal quantities probably should go proportionally. And think of what happens if there is a shock. Well, at the end, the final result is higher inflation. By how much? This is a theorem, you can prove it. It is the size of the shock divided the mean lag of the process. Basically, it says the longer the inertia, the smaller the end result. That is, paradoxically, if there was a lot of inflation, you could ignore that because the impact, since already we were below the 2%, would have brought to that. What happens? Well, it happens something very simple, that there was higher frequency of adjustments, the non-linearity, and the risk of wage sector catching up, which would have added to the lowering of inertia. And where did central banks enter? They entered re-establishing a normal propagation of effects and lengthening again the inertia. Had they not been, this is a counterfactual, it has to be, there must be some research done on that, but I'm convinced that this is where central banks actually entered. And the second question is, had the shocks not been temporary but more persistent, what would have happened? Well, tightening would have had to be much stronger, and at the end, potentially, higher costs, and we would have, rather than a soft landing, a hard landing, and that is life. There are issues. I will not go through much, but I point to three issues. One has to do with the forecasting errors, projection errors. The second has to do with the role of expectations. The third with the natural rate. Natural rate, I dispose it off very quickly. It may be used for policy making, or it may be used to somehow identifying the the restriction in monetary policy. I'm skeptical on the first. I think the second could be useful together with other magnitudes that should be considered. But the forecasting, there's been a lot of thinking about models are wrong, the central bank used the wrong models, and they are not flexible in their use, especially in the Bank of England. But as you know, but you know, monetary policy is not done with models. Monetary policy uses some of the projections that come out of models, but models are used in an intelligent way, not in a mechanical way. I don't like the SGEs, for those who know what these SGEs are, but I don't think that that was the reason for the projection failure. The projection failure was due to two main reasons. The first, wrong assumptions. And the second, changes in behavior that now really we have to take into account. The non-linearity, the changes in the labor and product markets, and the role of expectations. There is a lot of work these days on surveys, on expectations, and so on. I think we should understand the importance of heterogeneity, the importance of the distribution of expectations, and so on. Expectation, however, I have some quotes, but I'll pass them now. But I want to discuss this one. It's Mervyn. Mervyn King says, central banks at the end first of all, had a mistake with all this forward guidance going on and on. And second, they thought that if they have tamed the expectations, then everything would have followed. Is it true or not? He is very skeptical about that. He thinks the world is much more complicated, and you can use simple rules to solve your problems. I'm skeptical of both of these claims. Certainly the world is complicated, but I think expectations have a role, and they have played a role. The simple rules, I don't buy it. This expectation channel, at the end, I already said, the ability to anchoring expectation, I think, has been crucial to counteract the non-linearities. So they have played a role. It isn't counterfactual. It is something that needs to be researched, but I think this is really where you should look for the effect of monetary policy. Obviously, we had very tight monetary policy. I think we accelerated the disinflation. Had it not been there, maybe there would have been a slower pace, but as the pace is low, the probability that there is reactions also in the labor market is higher. And therefore, you were able really to reduce that probability. There was, however, a problem in communication. And the problem in communication is crucial because if you are not able to communicate how good monetary policy is and how much is due to that, then you see all the political pressures that are taking place. But also there was this interesting paper I just read of the Dutch central bank that shows that at the end, even everything is good in the United States and inflation is down and monetary policy has been successful, consumers still think inflation is too high, they are damaged, monetary policy is not really its job. So there is a problem of communication. Communication not only with politicians, but with other constituencies as well. Natural rate, I leave it to John. And where do we stand now? Central banks entered the race against inflation with a handicap. The handicap is QE, and somewhat after the starting gun. The tightening of monetary conditions has been effective without giving way to strong political pressures, which have been there. Overall, there has been no loss of credibility, and this is evidenced by the anchoring of inflation expectations. At the end, well, we may discuss whether central banks have been behind the curve or not. I think not much. And this contributed to faster disinflation as supply shocks receded. Inflation now is approaching 2% without a wage price spiral and without obvious recessionary effects, at least so far. It should be reminded that in Europe, who are net importers of energy, a price shock is effectively a tax. It cannot be avoided by a sterile race between prices and wages. Prudence is fundamental there to ensure that nominal adjustments remain spread out over time. There is a last mile. Last mile, the efforts depend on items which are more responsive to labor or less to energy. It may take time, but I think current monetary policy stance is such that barring any new shocks, inflation will be closed, the gap will be closed as expected. There is high global uncertainty, and it would be sensible to continue to move gradually out of the restrictive territory, monitoring carefully the risk, including those stemming from geopolitical events. The lessons. New institutional framework of central banks, I think, passed the first test of high inflation. Institutional changes in financial product and labor market have been a positive factor. Discretion and flexibility of central banks have been and will continue to be crucial, but this does not mean arbitrariness, but learning to better account for non-linearities, expectations, and regime changes, also the risk of regime changes. Central banks need to communicate better, both about their forecasts and their reaction functions. In fact, a data-driven approach cannot be the rule, and the conditionality of the statement should be made clear. Conditionality means that in rules and discretion, simple rules I don't think that work. I stick with Paul Samuelson's observation that after all, even a rule is chosen by discretion, is abandoned by discretion, and is interfered with by discretion. There are issues on fiscal dominance, issues on financial dominance. I leave it to the debate, and I close. And the close is the following. There are two words which feature prominently in last year's report on central banks' post-pandemic performance. One was patience, and the other was humility. Patience in the ICMB report, humility in the G30. But Mervyn King has always said, be humble. Mervyn. And patience was recommended to avoid excessive tightening as disinflation prospects were rapidly improving. Correct. But I still think that also today there are reasons to be prudent while returning to more normal conditions. Finally, central bankers know very well that they don't know much, as most of us, when there are major shocks and regime changes are likely. I feel they also know the virtue of being humble. This does not mean that they should be hesitant or submissive. Indeed, if anything, we can refer to a Greek oxymoron, speude bradeos, borrowed by the Romans as festina lente, and I'm sure is not lacking in other cultures. This means make haste slowly. Thank you.